Right this whole week. Like I've been asking people the same question like 10 times. I'm kind of concerned about my head.
All right, one small correction on the cover page, small correction. The last presentation today by Kevin, that's actually an international technology company, okay? That's a Canadian company. And I failed to put international on there. So today we're going to have 2 international, 3 domestic, and this is the second to last week of the semester. We'll have 4 presentations next week. Are you ready, Jess?
Yes, I just want to make sure you'll have to stand
Okay, no, I can see
back
this.
there. Yes, okay. All right,
Okay,
we're live.
And then we'll put that on this screen back here too. Okay, well, good. Welcome, everyone. I think this is week 11 of presentations, the second last of the semester. 5 presentations today. We'll stay right on schedule here. Some of us have a 2 o'clock meeting, so we'll be done well before then. Please ask questions. I thought the dialogue out in the D2L discussion board was very good. I'm pleased with that. Good responses, good questions. And it is fair to bring up some of those questions as well, just for the benefit of everyone. All right, so first of all, Richie, Zaro, we're going to do Paylocity. All set, Richie? All right, good. Welcome.
Thank you. My name is Richie. I'm a junior. I cover domestic information technology, and I am pitching Paylocity Holding Corporation. Paylocity is a market leader in the HCM software space of a deal in the development and provision of cloud-based software solutions aims towards small and mid-sized clients. They have an all-in-one platform that is fully integrated. They offer cloud-based payroll, human capital management applications, time labor tracking, benefits tracking, workplace collaboration and communication tools, and talent management. And for my screening process, I used FinViz and FactSet. I was looking for a unique company with a business that I found interesting. I wanted something that had a lot of growth potential and was in a very large growing industry. And I thought that Paylocity fit that description. Paylocity's all-in-one human capital management system is the only one on it, only one like it on the market, and something that really drew me to the company. And additionally, they have a lot of experience management. There's co-CEOs both having experience in other HCM software companies. And I found Paylocity to be positioned for a lot of growth. And as the need for HCM management solutions rise, I thought Paylocity was a great stock to have. So that's my vision today.
All right, I'm going to serve as moderator here today. I'll ask the first question, then we'll look for questions from the group. You know, I'm always attracted to return on assets, return on equity. There's quite a difference, 3% versus 16. I certainly like the 16. I don't see a ton of traditional leverage. Your debt to equity is only 16%. Where does the other leverage come from? Do they have capital leases? Are there deferred liabilities of some sort?
There are some deferred liabilities. I don't have the exact figure on that, but they also do have lease obligations that have.
Okay. All right, let's open up. Basil, you got a question?
Yeah, could you touch on their operating margin growth and could you quantify that more? Why should we buy it at this stage while their peers are almost twice as much?
Their operating margin growth, like I mentioned, like in the discussions, a lot of what is going to drive their operating income growth is just their acquisition of customers.
Yes.
Just in the past year, they've gained over 4,000, and that's about a 20% increase. And like that's been the historical rate that they've had. Like from 2020 to 21 to 21 to 22, it's roughly 20%. So I'm estimating them to continue that growth.
Okay.
And management indicated that with so many customers, their economies of scale are going to go up substantially. And in addition to that, they're working on selling more to their clients. Traditionally, a lot of their clients don't sell or don't purchase all of their products. So they're working towards selling more of the solutions to their existing clients. So that reduces costs of acquiring the customers, hence the larger income or operating income growth.
Okay, awesome, thank you.
Brian.
Can you just touch on your insider holdings? I see it's at 27.5%. Who's holding that large chunk in the company, and what's your confidence that they keep holding that?
Well, their largest shareholder is just the founder. I forget what his name is, and then also their co-CEOs, being Stephen R. Buchamp. I'm very confident in that, just because them holding that much of the company shows that they believe in it and that it has a lot of potential. So I'm very confident in their insider ownership.
Okay, we do Bill.
I'm not surprised just that we've had a lot of technology companies we've recommended this year, and usually they have to go up to 10 years in terms of PCTY. What is the, can you discuss your little remodel, because you only did 5 years. Help me understand why it's so short.
I just did a 5-year model just because up until around 2024, their multiples started to look similar towards their competitors. For example, their operating margins, that's something that I touched on earlier. They're expected to grow up until around 20%, which is the year average by 2025. So I kind of just modeled up until then, just a 5-year.
Hi, Richie. Going back to the margins, so they're growing over like 100% in 2022. So the revenue estimates seem to be like on par with other estimates. Is there something going on with their operating expenses and COGS that like we're not seeing, or what's happening? Why the over 100% increase?
That's mostly just because of deferred income and revenues from COVID-19 and just the recovery from that. Their COGS haven't really decreased since then. It's just been a steady growth in my model. I can share that with you later if you'd like to see it.
Andrew.
Yeah, hi Richie, nice job. You mentioned ADP in the competition report. I noticed ADP has a higher ROE. Could you kind of talk about ADP's historical margins and how their market share compares to ADP?
You're asking about their market share?
Yeah, market share and historical margins. That's how they compare.
I'm not exactly sure what their margin or their market percentage is. I'll get back to you on that. And their margins, I do know that they are, around 22%, which is what, that's been like pretty steady because they're a very large company. They've kind of been more of like a value company. As of recently, they don't really have like that much growth left just because they're so big already. And Paylocity is on track to get to around their 20 or so percent operating margin. So I think that was that small answer.
Given that ADP is a major competitor of theirs, for your buy-sell, you will want to clarify. You said you get back to them, that's a good place to follow up on that. We have a guest with us today, AIM alum, corporate leader of Baird. What year, if I can ask?
Marquette.
What year?
2010.
2010. Wow. It just seems like just yesterday. Perfect.
Same room though.
Yeah.
Oh, yeah. Do you think, so you forecast out the revenue growth, do they have to take market share from the big competitors to do that, or do all the players equally win? Is it just a penetration thing? How do you think about that?
It's partially because just the industry is growing, and partially because they're just eating away at some of the competitors' customers. They just have like a much more like integrated and all-in product, something that doesn't really exist in other competitors. They only like a lot of competitors like Paychex and Paycom, they rely on like third parties to have their software like work. Paylocity doesn't really do that, so that's something that's really attractive. So, and that's kind of what helps them like eat away at their competitors. If that answers the question.
Other question? We could do one more. Yeah, August.
Great work. So Paylocity was founded 25 years ago. Why are you confident now that they're going to start realizing economies of scale?
I would say just because of their rapid customer growth in the recent years, it just the HCM software market has really exploded in the past like 5 or so years, and I think now they're realizing how important their product is, and just how scalable it is.
And hopefully this transfer to the cloud with everything they're doing does give them some of those economies of scale that can improve margin. Kind of answered by the fintech person in the room, okay? We hope to get those economies as you do that. Last question is yours, Bill.
Oh, I was just gonna use, since you said your company's gonna get mature margins by 24, 25, why don't you do a PE on those numbers instead of the most recent numbers you had in the model?
I'm not sure.
We got one quick one back here.
So I noticed client growth is your first driver, and you say that they'll continue to grow at least 20% per year after COVID effects. So you say that they also are able to differentiate themselves in their human capital management. What are some of those differentiating factors that will help them keep growing their client base?
Like I mentioned, just like all-in-one platform. Everything is fully integrated, and it kind of just reduces the need for like redundancies and inefficiencies that a lot of other competitors have. And that's just something that a lot of their clients really do like. And around 25% of Paylocity's new revenues from customers are from like referrals. So it just, people like the software, and they're going to continue to refer it and just talk about it, and they're going to continue to grow.
Great, thank you.
All right, Richie, thanks for going first. All right, Grace, I'm looking forward to your pronunciations of some of these.
Tommy Mob?
Yeah, these are tricky words.
No.
All right. Floor is yours.
Awesome. Hi, everyone. My name is Grace Schwartz. I am a junior in the AIM program, and I cover the international healthcare sector. So to kind of go a little bit into my screening process, this time I used a FactSet screen, and I looked more kind of in lower risk areas for the countries. I also wanted to do kind of more of a mid-size rather than a small company. And so with about looking at 50 companies, I kind of looked to see if there were any that really bounced out at me and that I really found interesting. And I definitely found that with Prothena. So just kind of highlight some of the things that I really like about this company and why I think that we should invest in it. Prothena is a smaller company, but it also has the backing of 3 really big, well-established companies. It has a very broad portfolio pipeline and looks at a lot of diseases, including Alzheimer's and Parkinson's. Yeah, and one more thing that I'd like to highlight. So the stock went up yesterday 12% and has been going up little by little today as well. The reason for that was because one of their drugs just got pushed into phase 1, and then that same drug got a fast track designation. So that's kind of the reason for the spike. There is still a 36% upside, I believe, for my DCF, and then like 41% upside if you take into consideration the relative valuation.
So I'll ask the first question. Thanks for your intro. Based on that news that happened yesterday, this is important for this company to continue to add new products to the pipeline and to advance them. Can you tell us more about that news yesterday and how it reflects overall on your thesis?
Yes, definitely. So kind of like going off of the history of the company, when it spun off of Elon company, how I kind of talk about in my write-up, as with all of their Alzheimer's, with their whole Alzheimer's portfolio. So this has kind of been a lot in the works, and also management has a lot of history working with Alzheimer's. So while the first 2 drugs that I am anticipating will be commercialized do not deal with Alzheimer's, this is definitely one of the biggest portions of the company. I don't really use it a lot in my assumptions in my DCF, just because I did a 7-year DCF, and this likely won't be commercialized within 7 years, but definitely a good step forward.
Okay, thank you.
Hey Grace, great job. Would you be able to elaborate a little more on why you used a terminal growth rate of 1.25%?
Yeah, definitely looking back, I probably would have used a 1.75 or even a 2% growth rate. I kind of found that it didn't have a whole lot of effect on it. I think each I moved it, it would move up 2% upside. So that's kind of why. But looking back, I would, because it is higher growth. Thank you.
Basil.
Yeah, could you please touch on your company's recent designations and like how it impacted the drug reaching the public market? Did you quantify that in your model recently or?
Yeah, so kind of when I was mapping out my timeline for when I thought these drugs would be pushed into different phases or commercialized, I did take into consideration management advisement, kind of the rates of other drugs moving through these phases, and also their fast track designation. So I believe the two designations that Bertamimab has is fast track designation and orphan drug designation. The fast track one kind of just gives the company a lot more meetings and correspondence with the FDA, so that helps move the process along a lot faster. And then the orphan drug designation is really helpful too, because basically if this drug is commercialized, it gives them 7 years of market exclusivity. They get some tax breaks on like clinical trial expenditures, and also it just helps. I think they have a rolling basis of reviewing data, so it gets reviewed faster.
Good, questions?
Hey Grace, nice job. I asked this online. You kind of touched on it a little bit. I didn't really get to see your answer, but Prothena separated from Elon in 2012. Could you talk a little bit about the history with Elon and how that plays into Prothena's current story?
Yeah, so Elon was also headquartered in Ireland, and basically they were bought out by a company called Igoe, and then when they were bought out, Prothena kind of spun off, taking all of the Alzheimer's research. So that's kind of what I touch on in my write-up when I say they have like decades of Alzheimer's research. That's a big factor, and it's also one of the things that I really like is a lot of the management has been with the company since Elon and kind of saw Prothena into this spinoff. Thank you.
Bill, can you give me a roadmap, like how products will be rolling out over the next 5 years?
Yeah, so the two ones that I kind of highlight the most in my DCF are Bertamimab and Prasinezumab, which is a Parkinson's disease treatment. So kind of the way that, as I was saying with Basil's question, I looked at the designations that they have and how that can move the process along farther, and that generally phase 2 and phase 3 kind of last from like 2 to 4 years. So Bertamimab is expected to come out with their phase 3 data in 2023. So that's why I have them being commercialized in 2024. And also I take a partial year, so I only take 5% of the possible revenues in that first year, because I don't expect it'll come out like right at the beginning of the year. And then I believe with Prasinezumab, I have that expected in like 2027.
Andrew.
Hi Grace, nice job. Really like this company. I have a question about their partnerships. I want to learn more about like the intent of these partnerships. Are they just keep the company afloat, or is there a strategic benefit to Prothena? And then could you also talk to me about the capital structure of the company? Because I'm worried about having some cash and liquidity issues.
Yeah, so the partnerships have been really important just because they don't have a certain product out just yet. But I'm sorry, like, are you getting at like what happens if these fall
More so
through?
like,
or
are these partnerships just to keep the company afloat, or do they have any research benefits or scalability benefits to these partnerships?
No, I would definitely say that they're long-term partnerships. So especially the one with Novo Nordisk, they are kind of, their ATTR business was purchased by Novo Nordisk. So basically Prothena will see that throughout the clinical trials, and then when commercialization and like sales start to come about, they will kind of get a chunk of that. And that's the same with Roche. So they'll likely be, I mean, as the contract stands, they will be like long-term collaborations.
Alex,
Yeah, great job, Grace. I see in 2021, the operating income growth is like 164%, meaning that it was negative before then. Can you kind of talk about the historical trend of net income and earnings per share for the company?
Yeah, so 2021 was kind of a weird year that skewed a lot of the like trends, and this was because this is when the Novo Nordisk purchase happened. So they received like 60 million upfront payment, and they received a lot of milestone payments that year. So that's why the revenues like was very inflated, and that's kind of what skewed that. Another component to this was before their collaboration with Roche was paying for this for like a certain drug to be taken throughout the, like they were paying for all of the R&D, and now Prothena pays for 30% of it.
Okay.
So it was kind of those two components led that to be inflated.
So were they profitable pre-2021 or?
No.
Okay. Thank you.
Corbett,
Just more curious in terms of coming at this name, like what was the source of research that you did on this? Is it just the filings, or how did you learn about and build knowledge on the drugs?
Yeah, kind of building knowledge on the drugs. I did a lot of research on, they released all of their clinical data and studies and stuff. I also did a lot of research on some of the diseases, like especially with bertamimab, just because that's the first one that I believe will be commercialized. I looked a lot at that just to see, are there other drugs in this space, and kind of looking at that, but
okay, so you said the name of that first drug, good for you, because I can't pronounce it. What about the other one?
I always have to like look at it. Prasinezumab, that's the potential treatment for Parkinson's, and this has been like a long time coming. So this is going to be the product of their partnership with Roche, which has been in the works since 2014. Right now, it's in phase 2, and I believe they're expecting to be in phase 3 in like 2 years, because it's been in phase 2 for a while. But it's kind of one of its focuses is a little different from other treatments on the market.
I'm gonna put you on the spot. What's your cell?
I don't know. I'm gonna figure it out.
All right.
I have 2 options.
All right. What are those 2 options?
People keep saying that.
No,
Isn't that in
this is
the
international.
international?
This is
I would sell. Can I sell Teladoc?
No, you're in the
Can you shift
international.
money over? Between CRISPR or Calliditas.
Need
Sorry,
that by tomorrow
Andrew.
morning, okay? All right, thank you, Grace. All right, Ayden, all set?
All good.
Take us to Florida.
I wish. Awesome. So my name is Ayden Domico. I'm a junior covering, and technically covering international finance, but I'm pitching a domestic finance today. I'm pitching Seacoast Banking Corporation of Florida, NASDAQ ticker SBCF. In my screening, I wanted to find a dividend-paying traditional bank that was still not fully mature in the business cycle. We're also experiencing high inflation as well, which means the Fed is likely to counteract with higher interest rates. And I wanted a bank that could manage that with a good loan-to-deposit ratio and strong management. Seacoast hit on all the points I touched on in the beginning. They resumed 1.5% dividends last fiscal year, and they've already moved to increase them from 13 cents a quarter to 17 cents a quarter this year. They have a rapid yet stable acquisition growth strategy, and they are still growing organically at the same time. They are positioned in the 3rd largest and fastest growing market, not only in the U.S., but also one of the fastest growing markets in the world. Before questions, I quickly wanted to correct an issue with my peer box. My peer weighting was a mistake, as I meant to weight them equally, but I will make the corrections here. With equal weighting, my price to book relative valuation comes out to $43.85. My price to earnings relative valuation comes out to $35.50. By weighing my 3 models, 70, 15, 15 respectively, an intrinsic value of $43.95 was reached, representing 33.87% in upside. And like I said, they currently pay a 1.5% dividend and growing. Now you can open it up for questions.
All right, Florida, all of their banks are in Florida. Which SEC region, or excuse me, SEC, thinking football here. Which Fed district are they in?
The Atlanta Fed.
And did you look at any of the forecasts of the Atlanta Fed about Florida? Expected growth over the short and midterm?
I didn't look through the Atlanta Fed. Florida, the state commission actually puts out their own projections in terms of GDP, population growth, what that may be. And so over COVID, Florida grew at a rate of 14.6%, which is double the rate that the U.S. population grew at that time. Over fiscal year 2021, Floridians' income, Florida citizens, their income grew 65.1% year over year, while the average for the entire U.S. came in at about 56.9%. Florida's GDP also grows at a higher rate than that of the entire U.S. nearly every single quarter. It's expected to grow 4.8% in fiscal year 22 and 3.1% in fiscal year 23. Obvious tailwinds in terms of resident and customer growth for both Florida and Seacoast include no state income tax, very warm climate, being surrounded by beaches, and increased economic opportunity. Personally, I see Florida continuing to grow faster than the U.S. As individuals continue to value their work-life balance over maybe income, which is very much to the advantage of Seacoast.
Gosh, it's like you were ready for that one, and we didn't rehearse either, so, Grace.
Hi, Ayden. Could you please tell me a little bit more about the acquisitions that the company's making and how do you think that they'll be able to manage this growth?
Yeah, they've made a total of now 14 acquisitions if you include the acquisition of Apollo that is currently still going through. It was made at I think March 29th, so they're still in the process of working out the details. They have made 13 other acquisitions prior to that since 2014. And I think management's really done a great job of managing that. It's not only management's job to execute those deals, but then to integrate new customers, new employees, new branches into Seacoast's existing culture and book of business. They've grown from about $4 billion total in loans and deposits before 2013 to over like $12 billion currently, both organic and inorganic growth. And I do believe in Seacoast management to be able to integrate that well and continue to grow within the state borders.
Thank you. Michael.
Yeah, good job, Ian. Could you touch on the third risk of PPP fraud? And is there any impact on deposits or any loans that they have, like Seacoast specifically has made with the fraud aspect of it?
Yeah, referring to PPP fraud, there's first and foremost, there's only PPP loans. There's no deposits. It's just the federal Paycheck Protection Program. Just in case someone doesn't know how it exactly works, I'll touch on it a little bit. It was designed by the government to help struggling business owners continue to pay their employees through COVID. Yet many misguided individuals falsified their ownership of a small business by creating a simple LLC. I'm sure we all know maybe some personal examples from whether it be back home or even here. So these people applied for and received PPP loans, which were then spent on non-business transactions. Federally chartered banks such as Seacoast were incentivized to help give out these loans, but Seacoast management actually seized the originations of new PPP loans before the end of fiscal year 2021. At the end of fiscal year 2021, they only had about $91 million left on their balance sheet in PPP loans, which is a decline of over 84% year over year from the year prior, over $500 million in PPP. So I'm really confident that by the end of fiscal year 22, there will be no PPP loans left on their balance sheet, and neither federal investigators nor the street have indicated that Seacoast is in any issues or peril with those PPP loans. So until that happens, I'm confident that they've managed it well.
Amy, you're right on. You're doing good questions. We got a whole bunch more, so we'll shorten up the questions and the answers to get them in.
Yeah, great job, Ayden. My question is just how does their online banking capabilities compare to their competitors, their larger competitors? Are they spending a lot in trying to develop the ability to open accounts online and all that? And can they compete with fintech banks that are not really geographically constrained?
Yeah, I would say that their online banking capabilities are pretty typical of a small regional bank. It's nothing short of what's expected for that. Seacoast has always kind of emphasized technology innovation within their culture. They were one of the first drive-up teller windows in all of Florida in the mid-1900s, and then they were later one of the first electronic ATMs. In terms of fintech banks, I'm not sure that they'll be able to keep up on that scale, given that that's what those companies strictly focus on. But they are actually more focused, I would say, on their internal technology. They have a customer relationship management technology that is created by FIS, and they've really leveraged that to get the most money per customer as possible.
Right.
Yeah, so your company went public in 1984. I see in May of 2006 they reached a peak price of $149. Do you know why that was? And can you get some color on that?
You know what? I don't know exactly why that is. I didn't really look much into the history previous to 2010, so my apologies. But I would have to assume that they were involved with some of the mortgage, I'll call it scamming, that was going on prior to 2008. And while the stock price has increased or decreased dramatically, I do think that Seacoast management has turned over since then, and I believe in the current management to continue with the business plan that they've put forward.
Very good. August.
Yeah, this is kind of a two-part question. But I noticed that on average, they issue about 10% of shares every year. Did you account for this dilution risk at all in your modeling? And then two, given their stock incentive programs, are you concerned that management aren't good capital allocators if they're using long-term funds to finance short-term benefits?
Yeah, I would say that in terms of dilution, I wouldn't really necessarily say that it dilutes the value of the business, given that when they are issuing shares, I'd say a vast majority of the time, they're issuing those shares to complete acquisitions. So they will issue shares in equivalent value of Seacoast stock to give to the shareholders of the target bank that they're acquiring. So even when they are creating additional shares, they're also creating additional value by bringing in new loans, new deposits, and new customers.
Hey, we're going to have Joe ask a question online here. Nice write-up. Can you explain the use, benefit, and meaning of bank efficiency ratios and tier 1 capital ratios in the box in your write-up?
Yeah, of course. So I'll start with the tier 1 capital ratio. Bank's capital is divided into tiers for regulatory purposes. Tier 1 capital includes core capital. It's comprised of a bank's common stock, retained earnings, accumulated other comprehensive income, non-cumulative perpetual preferred stock, and any regulatory adjustments to those accounts can be calculated by dividing total tier 1 capital by the bank's total amount of risk-weighted assets. And the higher the ratio, the more well-funded a bank is to continue its operations. By law, banks must maintain a total capital ratio of 8%, and tier 1 must account for at least 6% of that. In fiscal year 2019, the industry average was 13.46%, which was up from the historical average of about 10% previous to that. Seacoast in fiscal year 2021 had a tier 1 capital ratio of 17.4%, which in my eyes says that they're very healthy and they will continue to operate on a healthy level. The bank efficiency ratio, it's also referred to as the cost to income ratio. It's dividing total operating expenses by total income, measures the bank's profitability relative to other similar banks within similar circles. Talking about my peers, I can go into those numbers if anyone would like those, but Seacoast's bank efficiency ratio of 55% is well above industry average.
Right, this has got to be a real short question, real short answer.
Great job, Ayden. So I noticed you have rising rates as a driver and conversely lowering rates as a risk. Do the forecasted rate hikes have a large enough material impact to compensate for the lowering volume?
Yes, so the bank's management produced a sensitivity analysis of how net interest income would be affected in the event of rate hikes or decreases. Just for some slight, very quick history background, from 17 to 19, there was a rising rate environment, whereas from 20 to 21, it was decreasing. Their net interest margin went up from about 3.5% to 3.92% in 2018, which is the height of rates. In 2020, it went down to 3.23%, so that's much lower. They do perform much better in high rate environments. Their sensitivity analysis by management said that if rates are hiked 100 basis points this year, 6.7% increase in net interest income over the next 12 months and 10.1% over the long term. And additionally, if there's another 100 basis points on top of that, the company will experience 13.4% net income increase in the first year and then 19.6%.
Hey, you got it. Thank you. have two presentations, and we're gonna end at 1:55. So both Jack and Kevin know that we're down to 10 minutes each, okay? Jack Bender.
Hey everybody, so I'm Jack Bender, I'm a junior in the AIM program, and I'm pitching Scott's Miracle-Gro company. The current price of $101.91 and a target of $124.60. A few things I wanted to address quickly online about my first driver. There were some things that were a little wrong in my write-up about that. So yeah, hydroponics is currently a $24 million market, but Scott's Miracle-Gro isn't doing hydroponic growing themselves. They are selling light fixtures, nutrients, and other like additives to go into it. It takes quite a good amount of science on on how to do hydroponics, how to do it effectively, so you can get the benefits of it as I laid out in that driver. So they did 1.4 billion in sales in their Hawthorne segment. That is their like hydroponic segment essentially, and it is largely based on cannabis growth in America, which marijuana sales in the U.S. were 8.7 billion in 2021. So yeah, now with that I can open to questions.
Okay, I know you answered this online, but it's really worth mentioning again. That's a big debt to equity ratio. Therefore, the concern is capital structure, the debt maturity schedule. Please talk about that.
Yeah, so I went into a good amount of detail with this online. I'm actually not too concerned about their debt ratios. They currently have an interest coverage ratio of 8.73. They have a maximum leverage covenant on their debt of 4.5. They're currently at 3.3. Also, I can talk about some of their debt that's maturing. They have a $500 million 4% loan due in 2031, $400 million 4.375% loan due in 2032, a $250 million 5.25 due in 2026, and a $450 million 4.5 due in 2029. Their management put out guidance on this as they issued roughly like $1 billion in debt in 2021 because they saw interest rates were about to rise and they wanted to lock in these rates for the long term. So I'm actually very confident in their management's ability with capital structure to get these low rates while they can and keep it at a level where they're getting the benefit while also managing the risk.
Brian.
Yeah, can you just touch on your ROE and how you compare your ROA and ROIC?
Yeah, this is really leverage. They're like 300% levered, obviously. So going through it, they had 50.9 ROE in 2021 and 54.9 in 2020. So their ROE number gets a little inflated by their leverage, but their ROIC number, I'd say, is pretty accurate.
How do you think about family ownership of the business and whether that's a good or bad thing?
Yeah, I'd say
in management.
Yeah, in their management, obviously, James Hagelorn is the current CEO, and there's other family members that work within the company. I'd say it's definitely can be a positive in that they're very collaborative and they want to have a long-term vision for the company. If the family members have a different view, can obviously be a problem. I would say they've had successions before where the father, who's the founder, left the company and the son took over, and they've done that successfully. And I would say that the current CEO has been a very good driver for growth for this company, mostly through the Hawthorne segment and also in 2001 when they merged with Scotts and became Scotts Miracle-Gro.
Great.
Hi, Jack. Could you tell me a little bit more about your second risk, increasing raw material prices? How long do you see this continuing, and how did you kind of incorporate this in your assumptions?
Yes, so I use futures for urea it's a material put into fertilizers. So I use their futures to model this out for their margins. Their management also talked about this in their Q1 call. They see urea and racine prices are starting to fall and turn the corner, which they see as very positive for margins. They did see some slides in margins in Q1, and that's seen in my model. As you can see, their operating margin goes from 13.63 in 2021 down to 10.53 for the year. So I do have that baked into my model. And this will be a difficult year for the company as, they've already set out guidance, which I talked about in my recommendation section.
So we're gonna go Corbin, then Michael, okay?
One of your thesis drivers is your strategy around acquisitions. Have you tracked the sunlight supply business, how that's performed since they acquired it?
No, I don't have specific numbers on that. I'd have to get back to you on that.
Why don't you enlighten us, Corbin?
I mean, I think it's important, right, if you're gonna spend that much capital on a business and you're gonna acquire it, you wanna make sure you get the right return on that, and that's executing versus them just growing for growth's sake.
Yeah.
Especially with a family management team at the helm, and they wanna just be acquisition hungry, so I just monitor that and think about whether they are actually, whether they can create value with the acquisitions that they do.
Yeah. I mean, I can say that their Hawthorne segment, back in 2016, was doing around 300 million in sales, and now they're doing 1.4 billion. And that acquisition is in that segment.
Any sense on the profit on that one?
The profitability, I'd have to get back to you on that with specific numbers, but I can do that for you.
We're gonna do Michael, then August.
Good job, Jack. Just kind of two smaller questions. Do they disclose how much of their revenues come from each other?
No, they don't do breakdowns of like their brands and what they're really doing. They do it overall.
And then, so in the recommendation part, pretty much their decreased outlook is because oversupply of cannabis. Is that a big part of their, I guess, growth strategy, is to be kind of provider of light fixtures or whatever you need to supply the cannabis industry?
Yeah, that's a big portion of their growth, and especially their Hawthorne segment is really focused on that. A lot of their acquisitions, specifically Lux Lighting, True, Liberty Bags, Sunlight Supply, Gadfia, and Botanica, those are all hydroponics companies that are focused on indoor growing of cannabis with light fixtures, like I've said. So yeah, a lot of their acquisitions are focused towards growth in that industry. And the oversupply is largely happening in California. About half of their Hawthorne segment comes from California, it's cannabis sales. So that's really a big area of the country to be looking at.
August.
Yeah, so it looks like since inception, the cash conversion cycle has hovered between like 80 and 90 days. Has management cited that they're trying to decrease this at all in like recent years?
Yeah, I haven't really found much on that. I would say they do a lot of their products, they get a lot of their product out to their retailers in Q1. Their Q1s, they only had one positive Q1 earnings wise in their history. It's just a bad time of the year for them because of the winter. So they generally try and get all of their product out to their retailers in Q1 and do a lot of their and prepare for the upcoming spring and summer months where they have better sales.
August, thanks for a balance sheet question. We need those.
I'm kind of curious about their stock chart. Could you kind of talk to me about what's been going on with their price for the past 12 months and kind of when you see this downward trend ending, even though it's not following the income and revenue?
Yeah, so during the pandemic, they had pretty incredible growth numbers. They grew like 31% in 2021 and 20% or 31% in 2020 during lockdowns and 19% in 2021. So they saw a huge upswing in their price. They got to like 224. It's their highest stock price. This is because millennials and a lot of younger people actually started gardening over the pandemic. It became a big growth industry. And in their Q1 call, they actually talked about how they've been worried over history about millennials ever getting into gardening and things like that. And they've said they're actually starting to see millennials as a driver for them that are actually driving their consumer segment sales, which does about 3.2 billion in 2021. So I think that's a pretty positive outlook for the company.
Hey, Corbin, you're a millennial. You gardening?
I am not. Not the posh stuff either.
Yeah, that's good. All right, Jack, thank you very much. All right, one more. We're right on schedule for the day. Keep the questions coming, please. Let's not get complacent down the stretch. We've got Kevin doing a Canadian. Remember, this is an international tech company.
Hi, everyone. I'm Kevin, junior in the AIM program, and today I'm pitching OpenText Corporation, a Canadian information management company. A little bit about, with a price target of $53 with 35% upside. A little bit about my screening. I looked for a company with positive 5-year sales growth, positive ROE, a good story, and just good management. And a couple of questions I want to touch on before I open it up to questions. With my ROIC being lower than my WACC, I'm not really worried about that. Their 5-year average ROIC is 7.2, and I also have a 100 bip premium in my WACC, so my WACC is a little inflated because I want to be pretty conservative. And I have ROIC growing to exceed my WACC in fiscal year 2022. And then I got some questions about their partnerships and alliances, about contracts. The management didn't really provide any information about contracts or timeframes, but partners such as SAP, Google Cloud, Amazon Web Services, and Microsoft, Oracle, all of them were in their 10Ks from 2017 to 2021. So I'm confident in their relationships for the future. And with that, I'll open up to questions.
I'm glad you opened by talking about the return on assets, invested capital, and equity. Again, longer term, what's the average been? Because I know the last couple of years, it's always challenging to look at financials. What have they typically done, ROIC or ROE long term?
It's right around like 7%. It was at 20% in 2017, and it grew up to that from around 16%.
So I'm going to follow up here. Dividend policy, or they're paying a dividend.
Mm-hmm.
What's the history of that, Ben? Do you know?
Yeah. So the last 7 years, the dividend has grown at a CAGR of 16%, and I just know the management has touched that they want 33% of future cash flows to go towards paying dividends and purchase shares or share repurchases.
And I'm going to do the balance sheet thing like you, August, here. Long-term debt to capital or to equity, quite high.
Yeah.
Did you look at that? The capital structure?
Yeah, I did.
Maturity?
So their debt schedule, they have one floating rate that's due in fiscal year 25. It's $1 billion loan. They refinanced it. They paid $10 million from fiscal year 22 to 24, 0.25% of the principal quarterly. So 1.84% interest rate, and then there's $933 million due in 2025, and then their senior notes, starting in 2028, there's a $900 million one due. 2029, $850 million. 2030, $900 million, and then 2031, $650 million.
Okay, questions? Michael, Grace, me.
Yeah, Kevin, good job. I was looking at their management earlier today, and I saw that in January of 2022, so just at the beginning of this year, they put in a new chief legal officer. Did their old chief legal officer was fired, or did he leave, or just kind of how did that succession go?
Yeah, good question. Yeah, so Gordon A. Davies is retiring effective September 2022, and Michael Aceto, who's been with the company since 2014, is replacing him. I think he's a great fit for management. He has prior experience at the law firm Skadden, Arps, Slate, Meyer, and Flom, and he practiced corporate and securities law with a concentration in international markets and M&A strategy, which is perfect with management strategic plan right now.
Hey, Kevin, could you please tell me a little bit about this third risk, about the CRA audit? Why did they issue a notice of reassessment, and if there were, what would be the effect on
so the CRA didn't agree with their transfer pricing methodology for certain international subsidiaries. So for fiscal year 12 to 15, if the worst case happened and they had to change their financials, approximately taxable income would increase by $90 million each year, and they would impose a 10% penalty on adjustment to income. And then for 2016 to 17, that was because of one of their subsidiaries in Luxembourg. And if CRA was to be correct and they'd have to change their financials, it could potentially cause a reduction to deferred tax assets by $470 million.
Was this unique to this company? The first couple years?
I'm not sure, but 2012, all the prior financial statements were fine, so
Okay.
it just happened in
Thank you.
2012.
I was just gonna ask about this. Okay. August, then Alex.
Yeah. By all your valuation metrics, it looks like Ziff Davis is cheaper and it returns better on equity assets and ROIC. What competitive advantage does OpenText have over them? And why not pitch Ziff Davis instead?
Yeah, so great question. So I'll just touch on my peers first. OpenText, like their competitors, they said their biggest competitor was IBM, which obviously would not be a realistic company to use for my relative valuation. So finding my peers was kind of a challenge. I thought they were the best measures of competitors, but Ziff Davis is kind of a different company. They're more of like an Internet of Things company. I would say the thing they relate closest to with OpenText is their supply chain management for retailers, which is kind of part of their professional services and others, which is their 8% revenue segment. So I think OpenText just has a better business model with cloud subscriptions and services and just more to offer.
Okay, I lost track. Who's next? Alex, then Margaret.
Yeah, great job, Kevin. I was just curious on kind of your second driver M&A strategy. Have they been paying a reasonable price for some of these acquisitions? Are they paying a premium? And kind of going off of previous questions from the last pitch, what's been the profit on those acquisitions?
They've definitely been paying reasonable prices. I believe it was $876 million and $896 million for Ziff and Carbonite. But Carbonite just started going to operation for OpenText in 2021, so I can't give you the numbers on profit for that. And to be honest, I don't have the Ziff numbers on hand. I can get back to you with that.
Perfect, thank you.
Margaret.
Kevin, nice job. I was just wondering if you could provide some information on the first risk with the data security and if they have a history of being hacked and what kind of system they use to do it.
So there's no history of them having any security breaches, but just with work from home being so prominent right now, there's an emphasis that third-party risks there's a higher chance of that happening right now. And they've really just, with Zix, it's like an enterprise solution for encryption, threat protection, that'll really help. And there's cyber resilience. They're just really big into, yeah.
Margaret took yours. Bill.
Can you talk a little bit about, just from you talk about the first lines that the revenues have grown 13.2% over the last 5 years or so. What is the best measure of, if I'm looking from a top-down perspective, what would be the best measure to look at from an area or sector, the technology sector, which best represent?
Why it's growing like that? I would say their cloud subscription and services. So they talk about ARR, how they want it to grow is one of their main goals. And that's the sum of their cloud subscription and services and customer support revenue. And in 2020, that grew at 12.8%, 2021, 12.6%. And then growing into my estimates, I have it growing at 13.6%, around 14% in the future. So I would say that's the best measure of why it's growing.
Today we were a little light on valuation. Didn't have a lot of questions. So let's finish on that note. EV to sales and some different approaches. Talk to us how you approach valuation for OpenText.
Well, their peers, like I said, they were hard to find, but I thought those were the best measures because like PE ratios for all those companies were very skewed. So I thought price to cash flows was very reasonable, and same with EV to sales. I just thought it was a good measure to use with the peers I was selected.
Grace, you have the last question.
Yeah, could you just tell me a little bit about why your operating income grew so much in 2021 and why you expect it to kind of drop off in 2022?
So in 2020 they did, I think their revenue growth from 2019 was only like 3%. So, and then it grew 9%. So that was what attributed the growth to operating income, and then growing steadily around 8%. It's kind of evens out in 2022 moving forward.
Thank you.
Okay, right on the button. Thank you, Kevin. All right, nice job. We all know the process, the 5 of you who presented today. I'm looking forward to your buy-sell recommendations. I'll produce a ballot, get it out over the weekend. You'll have until 9 o'clock Sunday night to vote. and we'll transact Monday morning. All right? Have a good weekend, everyone. Take care. Good job. Good job. All right, I gotta be downstairs.
Hurts.